So stocks closed at a new all-time high today, but we're still within the 4-week range. So I'm going to break down today's move within the context of what we've been talking about in terms of expectations. How bullish we expect to continue to be, what's driving this action as we head into a very important week from a monetary policy standpoint, as well as a fiscal policy standpoint, with the tax reform bill going back and forth between the House and Senate, as well as comments coming from overseas regarding the tax reform bill. So I break all that down in today's video, how that's impacting the stock market and the market posture. And as always, a way to trade a sector that's making a little bit of a comeback today. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Monday, December the 11th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button that's right down there below this video. Of course, hit that thumbs up right next to it and like today's video. Let me know that you found it useful with one click. Easy way to give me some feedback there. Scroll down even further. Comment on anything that stood out to you from today's video. Let me know what you learned. In the description, you'll see a bunch of links there. Subscribe to my daily Market Outlook email newsletter by using the link that's in that description. And of course, there's more content that I put out throughout the day. I do that on Twitter, so follow me on Twitter with the address you see at the top, at DavidSettle42. You'll see pinned to the top of my timeline is tonight's Market Outlook tweet. Like and retweet that. Help make sure Twitter keeps pushing you all of my stuff by doing that. And of course, join the Market Outlook community on Facebook. There's the address again at the top of the screen. You'll also see an address to get there. It might be a little easier for you with a link down in the description below. All right, well, let's take a look at the S&P 500 here and take a look using the market forecast technical indicator down there. You can see at the bottom. So we're back. The intermediate line is turned back up. So we've had three strong days here in a row. Technically 4 up days, but that first day closed lower than the previous day's close, even though it closed higher than that particular day's open, which is why it's not filled in. It is red, but it's not filled in. So you could say we kind of started off at that day's open. That's when the rally started, but we didn't have a good close, bullish close until here, and we closed above that day's high point. So closed above the high of the low day supposedly. We're approaching those all-time highs there. Again, we talked about this idea that we'll kind of muck around in here. Whether or not we get up to a new high, that's not what I'm expecting. Of course, anything can happen, but considering the length of the trend that we've already been on, which is now going on, almost 4 months, and how high market sentiment is, and considering we passed 80 back here in the end of October, we've had a decent run already, and usually when we get above 80, it doesn't go anywhere. So, you can kind of see here we had a similar run like this, and when we crossed above 80, we had a late push in February that was in the 4th month of a rally when market sentiment was coming off of a much lower low point, and then we just didn't go anywhere while we continued to trace downward. And so you can see something similar lining up here. So if we get up to new all-time highs, which we are, we're at new all-time closing highs. For the S&P, just not up to a new intraday high point. So whether or not we get above that high point remains to be seen. If we do, I just don't expect us to get too far higher, and I don't expect this near-term run, which now, that near-term line solidly bullish up to the 99th percentile. So solid bullish there, and this is what day 2. I don't think we'll get a typical 7 to 12 day run on this near-term line. Of course, anything can happen, and we've had good runs so far on this particular intermediate run. We've had one, started over here of that near-term run. Then we had a little bit of a pullback, and then we had 1, 2, 3, 4 solid near-term runs within this 3+ month rally with market sentiment this high. So that's why I'm not really looking to, and you'll see other reasons why too. I'm not too particularly bullish. The Dow looks very similar, strong near term. The momentum line pulled back. The market intermediate line is turned higher. Market sentiment's very high. So very similar picture to the S&P 500. Still got that long lower shadow that we're still trading within. Remember, that long lower shadows, the tops of them can act as a resistance level there. There's our NASDAQ. You can see it's turned back bullish again. Near-term line not as extremely high, not getting up to a new all-time highs here yet on the NASDAQ. And, of course, the Russell 2000, which has been lagging during this past couple of days. But take a look at its market forecast indicator here. And you can see we're not anywhere close to all-time highs on it, and well below the long upper shadows high point. And you can see its market, its near-term line's not in the reversal zone. Its intermediate posture is actually still bearish and stronger than what any of the other large cap indexes are. So you can see we're not really getting a lot of strength in the small caps. We're getting a lot of strength in the large caps, particularly the blue chippers, but not so much in small caps. So that's a little bit of a concern, and another reason why I'm just not too not too much on that bullish bandwagon yet until we get more of a pullback in the broader market in the S&P 500. Again, not looking for like 10%, 20% bear market. Even just a 5% pullback, just a normal, healthy, bringing the intermediate line down below 50. Now we have an opportunity and hopefully get the market sentiment line down at least around 70, so that there's opportunity for those to, for longer term intermediate runs. Otherwise, we're just going to get a lot of choppiness, which is totally what I expect right now. And this is why I don't think we're going to get like a 20% pullback anytime soon. One of the reasons, because we're so far up above the 50. The 50 is so far up above the 200 that we just don't see deep pullbacks from such strong bullish levels. Usually we see really slow grinding moves as those two lines catch up to each other. And that's on the long-term chart. On a more intermediate basis, you can see while we never did during this little pullback here drop below the 8-day moving average, now we're right back pretty, not as extremely above it as we were back at the end of November, but it's a pretty solid move. And you can see the MACD is not forming a higher high point, even though we're getting a higher close right now. The stochastics is just barely getting up to its moving average. So there's a divergence setting up on the MACD and definitely on the stochastics too. While it may get above its moving average, probably not significant quite yet. It did turn up, but still not quite strongly bullish on any of these. The long-term chart in terms of like with potential to be bullish from today going forward on either that long-term chart or on this intermediate chart. We had another bullish intraday candle. We started the day with a gap up, small gap up, and then the low was early. We rallied right off the open, pulled back down to Friday's high point and today's open for that matter, bounced off of it, closed for the second consecutive day at the high of the day. So higher high, higher low, closing at the high of the day above yesterday's high point. Still not above the 4-week high, and so we're still trading, and that was kind of the expectation is in this 4-week range. We've got the midpoint for now. Now in a few days we're going to move that low point up, but for now the middle part of this range we're looking at about 260.50, right? So as long as we're in the upper half, we're okay. I don't think if we do push this up, considering we're already so far up, we might push it up, if we do push it up, another dollar or two as we'll move the low point up another dollar or two. But then again, you can see, as we move it up to say, eventually we're going to move it up to, right in this area. We're going to start moving up higher and higher. And as we do, you'll notice this will become the midpoint of the range, of the 4-week range. So, and then we'll tighten up. And then unless we keep pushing this up as we pull this higher down from the bottom and keep the range in this kind of bullish zone, if we start tightening up, it'll make the midpoint smaller and smaller and smaller to the point where this will be the midpoint of the low, and then the midpoint will be in this 264 area. Now it'll get a lot easier to trade in that point. So you can see how now we trade below 264 in this area, and it wouldn't be so bad because easily in the upper half of the chart. A couple of weeks from now, if we don't push up to new highs, then now that area is going to become a lot more bearish and have the higher probability of breaking to the downside. All right, so the daily chart's got something going on here with a bad pricing. So we'll take a look at the range from this chart here, and you can see the range is just about almost a point, so a little less than a point. So very small range there. Of course, again, that bad price will throw us off, but a small range of just over a point. And then the volume, again, that's not bullish volume. We want the volume to get back to 50 or below to really be bullish. So small trading range, which is positive, that will help bring me below ones way down here. So that will bring that line down. But the volume at 80 million, that's not going to bring that line down. So and then you consider the volatility index, which is now back below 9.5. Like, we don't get below 9.5 very often. So it was that fast. So we dropped down this far just really in the last couple of days. And then on a relative basis, already back down below the 77%. So 80%, remember, is extreme. Getting below 75% would really be extreme. And you can see that's usually been the cause of moves higher in this ratio. When the VIX goes up against the 3-month index, it goes up by itself. And when the VIX goes up by itself, usually stocks pull back too. So, the technicals are setting up for, this near-term bounce to be short-lived and for things to roll back over. Again, not necessarily to a bear market, but roll back over. Remember, we can roll back over on this current trend and this trade in here and still be fine, because here is still the upper half of the 4-week range. And as long as you're in the upper half of the 4-week range, you're good. So we can still pull back even into this area. The problem is going to be when we start to move this up, but we still got about another couple of weeks before we move it up to that low point, without any moves higher on this level. And we could still move another, like I said, $1 or $2 higher on that, considering we're going to move this up here in a couple of days, another $1 or $2 higher as well. So now let's talk about what's driving the price action today. And before we get going on that, my daily reminder to follow me on Twitter if you're not already, and to get more content throughout the day, and to make sure Twitter with its algorithms pushes you my content. Make sure you're liking and retweeting what you see. In particular, you can just go, again, always pin to the top of my tweet, my feed, is today's market outlook tweet. So make sure you like and retweet that. Twitter will make sure they keep pushing you my stuff, and then the more you do that, the more all of these followers will be able to see my stuff because of the engagement that you're providing. So thank you for that. And one of the things that I tweeted out today is this interesting piece here that talked about that this might be the only year on a total return basis that the S&P 500 closes every month of the year higher. We've had 3 years in the past so many years, 3 times where we've closed 11 out of the 12 months higher. And so 11 for 11. And you can see the year after that, this one was 9 months positive. This one was 10 months. And then this one was 7 months. So all 3 of those years following those 11 for 11s had strong return, had positive years and pretty decent returns. So you can see that more about that link there. So I'd recommend you check that out. But that kind of gives us an idea heading into 2018 that while things are really overbought, we might still have another decent year. Just like, again, the last time we had an 11 for 11 was 2005, which 2006, the market didn't peak until 2007. So we still had some time. And like I said, I've shown you before, the yield curve falling where it's at, the Fed raising rates. That the Fed was raising rates from 04 through 06, and then the market, and then remember the yield curve got to this level where it's at now in March of 06. So we still had more than a year, 18 months, more than 18 months of positive returns before the market peaked. And even then, the market peaked in October of 07 and started to trend lower and didn't really start to hit the fan in the summer of 08, and especially, of course, in the fall of 08 when things really went crazy. So, that was a whole year after the market actually hit a peak. So things won't fall off a cliff and highs. And, according to a lot of these things, we don't look like we're going to fall off a cliff anytime soon. All right, so looking at the calendar, the biggest thing that came out today, and usually Mondays are quiet, but we actually had an announcement, and that was the JOLTS number. Less than expected, a little bit of a pullback. The main thing that happened was the release of the Bitcoin futures, and another not insane move higher, considering for Bitcoin, but a decent move higher today. And it's interesting to see the reaction of the market. So, you know, the economic indicators look great. So you'd think, okay, well, the Fed should, the Fed is on board with raising interest rates. And you can see, so here's the June rates. And the main thing that happened today was a drop in the odds of a rate hike. You can see, so this is the December hike. This is the March hike, the 150 to 175. So you can see if I go to December, it actually pulled back down a little bit. But there's your, by December we'll be at 125.50 to 150. So that's 125, 150, that's December. And then you see there's the same line. We actually have higher odds now that we'll get another hike in March. And that stayed flat today, so that's 150 to 175. And then we look at June, and you see, okay, well, 150 to 175 by March went up. So higher odds by June. But then the second hike by June pulled down. And the odds that we won't get a hike at all by June pulled up. So it's either we'll get a hike in March or not, is what we kind of saw today. So kind of an interesting move. Now granted, the only other indicator that came out was this auction, and it doesn't even have a green. So the red ones are the ones that like really pay attention to. The green ones are okay, let's pay attention. They usually don't move the market, and then of course all the rest of them don't really have to pay attention to. But in the 10-year note auction, there wasn't a lot of demand for 10-year notes, even with their yields as high as they are, which makes the prices a lot cheaper than normal. There wasn't a lot of demand for that, and so the bond market itself is showing some dovishness, and not a lot. So these odds are still pretty, still pretty decent odds that we'll get 2 hikes, but by June in 2018. But it's like, okay, the odds of a hike in March stayed flat, and now the odds of another hike in June pulled back down, and so that's a pretty dovish, considering how overvalued the markets are. Another new high, another new all-time high in the S&P closing high. How bullish the economic indicators are. Pretty decent GDP estimates, not revised. They're still 2.9%. So all of that, and Bitcoin causing this. You wonder is the market saying, okay, just in case, and that's one of the other things I tweeted out this morning, was is that the one thing that could trigger excess, right? Because bull markets don't die of old age, they die of excess. Is that the excess? Is this the one thing that's going to provide excess for the markets that will cause some craziness? Of course, right now, the pain trade for Bitcoin is to the upside because everybody thinks it's going to crash, right? So the pain trade still to the upside until the pain trade is to the downside, and everyone's thinking, okay, well, it's here to stay, it's going higher, and then the pain trade becomes to the downside. That's when things can get pretty nuts. And again, considering the technical issues, that we talked about here, that might not be next year. The expectations would be that might be still another year or 2 away, for that matter. So we're not like talking about by next month the pain trade will be to the downside. Now it could take a while for this to really get established, to be able to draw everybody's mom and pops in into it, to where they think there's no risk or little risk to the downside now, similar to how real estate got. Remember, real estate got to the point where it's like, real estate prices will never drop. Yes, they're crazy high, but it's a real estate market. It's limited land, and it can't go down. And the same thing in the internet bubble. They got to the point where it's the internet. It's going crazy. We've got a new economy now that things will never go down because of all this great innovation. And lo and behold, bubbles burst. And we're not to that point yet on Bitcoin. But as of right now, that's really the only excessive thing, because no one else is really piling in excessively into any area of the market other than cryptocurrencies. All right, so take a quick look at these 2 charts, and you can see over the past 3 days, and really over the past couple of days, it's been energy has been really rallying the market higher. Crude oil is up 3.5% in the last few days. The broad market is outpacing small cap stocks, not the most bullish signs. But that's really the only relationship that's not bullish. High yield is outpacing treasuries as yields move up. The dollar's been strong. That's been pushing gold down. So you've got gold on one extreme. You've got crude oil on the other extreme. So that's very bullish. And of course, emerging markets outpacing developed markets, which is what you'd expect. So pretty risk-on relationship there, except in the U.S. stock market. And we talked about that. You know, the small cap index started strong, but then pretty much from this peak here, crude oil kept higher, and look at the gap in performance from that peak on last Thursday morning to now. There's about a full point, more than a point percentage difference there between large cap stocks and small cap stocks, and same on developed markets versus emerging markets. So while there's risk taking in the markets, U.S. stocks, the stock people are moving towards those large cap issues away from the smaller cap issues lately. And that was something else too that I tweeted out from before, that Brandon tweeted out about the idea that right here, these are the dividend aristocrats, but money is moving into those higher quality stocks, value stocks versus growth stocks. People are looking, to put their money in U.S. markets in areas that will hold its value just in case we get any kind of intermediate pullback like we're expecting. Speaking of Brandon, we're just a few days away from getting him back on here, so we're really, really close. Those of you that are highly anticipating, myself included, having him back on and hearing his take on things, the wait will be coming to an end here pretty soon. So from a sector rotation standpoint, again, energy stocks performing well. Look at technology. Utilities kind of rallying here late, even with higher yields. So that's an interesting move. On the other end, financials not benefiting from the higher yields. So I just go to the past 3 days as a whole. Not surprising, energy stocks rallying, but technology stocks are outpacing the U.S. Markets. And then you have healthcare that is rallying too, interestingly enough, during enrollment season. Whereas on the other end of the spectrum, consumer staples struggling, lagging significantly. Utilities were lagging until this late push, and you can see all 3 days a push higher by utilities. Again, a little bit of a flight to safety. Industrials also had a good start to this run, a little bit of a pullback, kind of matching the market, but it's been mostly a technology run that's fueled this short-term bounce. And that takes us to our trade idea of the day, and we haven't looked at this one for a while, so we'll go ahead and delete these drawings. Somewhat outdated. You can see now that Symantec, which is in that technology area, is a stock that stood out to me today. Let's take a look at just the regular 3 green arrow chart. You can see we did get 3 green arrows breaking up above the previous high point here already in 1 day, with 1.5 times the average volume. So 3 green arrows, 1.5 times the average volume, breaking up to a new higher high, slightly higher high, but a higher high nonetheless. And coming off of a divergent low point. So it was a lower low, but not on the indicators. The indicators showed a higher low. So stochastic's close to crossing its moving average. MACD is already above its moving average, close to crossing above 0. You can see from a market forecast perspective, we have an oversold intermediate line, but that near-term line now getting into the reversal zone, suggesting the possibility that this posture can turn bullish. And if it does turn bullish and get above 50, you can see that last time it got up to 34 when it did that. From a long-term moving average perspective, we've been trading below the 200-day moving average, kind of holding support at 27.5. Now looking to get back up above that 200-day moving average potentially, and the 50, because they're right next to each other. So there's opportunity here for it to bounce. And if it gets below 27.50, then we know this trade's done. So we got about a $2 risk and a roughly $4 gain to these previous highs here. So we got about a 2-to-1 reward to risk ratio just to make a trade. If we were just to make a stock trade, we got about a 2-to-1 reward to risk ratio here, just for a swing, just for maybe a couple of months, maybe a month or two swing. If it were to break 34 and continue higher into 2018, then of course, we might get more than a 2-to-1 reward to risk ratio. So there's opportunity if this ends up being the beginnings of a more extended bullish move, and for Symantec in particular. The nice thing is there's a pretty darn obvious low point here to know if and when this trade doesn't work, take the small loss, move on to another trade. But you can see technology's been surprising last couple of days, and today Symantec was really a big beneficiary of that. So a relatively quiet start to the week with a lot of central bank news going to be on the horizon this week. The Fed on Wednesday with their rate decision, expected to raise rates. ECB, Bank of England coming out. They've been, some of the finance ministers from some of these areas in Europe not so happy with the U.S. Tax reform bill. So some interesting things coming out there. So we might see, but it'll be interesting to see the interactions between Fed monetary and fiscal policies here with what's going on in Europe and their partners over there in Europe, to see how they respond to what the U.S. is doing with our new fiscal policy approach that we haven't had until this new administration. So other than that, pretty quiet. As Bitcoin's obviously been probably dominating TV almost all day today with their futures contracts. The market's just kind of waiting to see, okay, what's the Fed going to set? What's the path they're going to set heading into the new year? So quiet day, but that doesn't mean everything was quiet. And we saw with our trade idea one opportunity to take advantage of a swing trade that could turn into more of a trend trade with the setup that we have today. Okay, with that being said, thank you again very much for watching tonight. Come back again tomorrow. I'll break down the market again tomorrow, as well as try to help you trade it with ideas on how to do that and what's driving the market. Remember to subscribe, like, and comment on the YouTube channel below. Remember also to follow me on Twitter for more content, and to like and retweet the content that you see there to make sure Twitter keeps pushing out to you. And if you haven't done already, make sure you join our community, the Market Outlook community on Facebook, with the address that's down in the description below. Have a great evening, everybody, and we'll see you all tomorrow.